A great place to start when looking for potentially undervalued stocks is to look for negative share price performance. And in this video, we'll be talking about 3 stocks who've just been getting the pie beaten out of them and look like prime pickups to your portfolio as we head into February. But before we get to those, in case you're new to the channel, my name is Ryan, and here we strictly talk about dividend stocks and how you can invest in them to create passive income and reach financial freedom. So if you love dividend stocks and if you're on a mission to retire early, then hit that subscribe button. I'd love to stay in touch as we both continue to grow our portfolios and collect that cash flow. Also, guys, leave me a comment below and let me know which stocks you currently have your eye on. I'd be curious to hear what you think is looking good. The first one on my list this month is going to be none other than Nike, whose share price has seen a pretty drastic decline since right around Christmas when they reported their earnings for the quarter, and in doing so, they gave a cautious outlook for the next few months. The company said they expect revenue in the third quarter to be slightly negative and in the fourth quarter to grow at a pretty lean rate. And so all in all, the near future may be a bit bumpy for Nike, and Wall Street doesn't like that, so it sent the share price heading south. Looking at the performance over here on Seeking Alpha, just in the last 30 days, Nike has seen a drop of about 8.5%, which is a very big drop in a very short amount of time. And if we zoom out looking at the performance over the last year, they're down a whopping 21.5%. But with that drop comes a great buying opportunity. Now, a share price decline this insane may not seem like good news, but if you're someone who is buying stocks and planning to hold on to them for a long period of time, this is actually great for you because the lower share price helps you stretch your investment dollars even farther, and you're able to buy these incredible companies, which Nike is, at a more attractive valuation. Think of it as if you were buying the shoes instead of the stock. Like, let's pretend you're about to buy a fresh pair of Air Force Ones, which right now are retailing for about $115. Now, if you apply a 21% discount to those, then you'd only be paying $91 for the same exact pair of shoes. You just saved nearly $25. The same thought process can apply to investing in stocks, and at the same time, as the share price goes down, the dividend yield goes up. In the case of Nike, the forward dividend yield is coming in at about 1.5%, which in its own right is not a very high yield. Admittedly, this is on the lower end, but the cool thing, because that share price has gone down so much, like I said, it's pushed the yield up, and right now the forward yield is sitting about 43.5% above the company's 5-year average yield. And looking at the rest of the dividend stats, there is a lot to like about this, guys. The payout ratio is coming in pretty low at about 40.6%. I really like to see that. Plenty of room to continue paying and even increasing the dividend, which they've done a great job of doing. The 5-year growth rate is sitting nice and high in the double digits at 11.13%. I love to see that. And they've been very consistent in increasing the dividend. They've been growing this bad boy for the last 11 straight years. So overall, Nike is a great looking dividend growth stock. And I think right now could be a good time to consider picking up some shares. Anyway, moving on to the second stock of the day, guys. You knew I was going to talk about this one. It's Starbucks, which I know I've been talking a lot about this one lately, but I still think it's a good buy, and it's one that I'm actually adding to myself right now. Over the last couple of weeks, I've added 4 shares to my Starbucks position, which leaves me with a total of about 44.5 shares. And at this point, I'm close enough to 50 shares that I'm just going to keep adding to it until I at least hit that number. I'm like right there, so I might as well keep chipping away at it. Anyway, we did talk about Starbucks in last month's video, but since then, guys, in the last 30 days, it's down another 2.6%. So it's an even better buy today than it was last month. And if we zoom out looking at the performance over the last year, they're down 10.7%. And there's a chance that the drop might not stop there. Starbucks is reporting their quarterly earnings on January 30th, and there's been concerns that the holiday quarter could have been weaker than usual for the company. In which case, I wouldn't be surprised if we saw the share price continue to go down. And I don't want to jinx it or anything, but I would not mind at all seeing Starbucks get under $90 per share. I'm going to knock on wood for that one. Anyway, just like with Nike, as Starbucks has seen that decline in share price, the yield continues to be on the rise, and right now is coming in at 2.43%, which is a pretty moderate yield. But once again, it's 21.4% above the company's 5-year average yield of 2%. So you're getting a much nicer cash flow return with Starbucks today. And looking at the dividend stats, the payout ratio is a bit on the higher end, I will say, coming in just below 61%. I do prefer to see the payout ratio about where we saw with Nike, closer to 40%, but we'll take it. The 5-year growth rate is still looking really sweet, coming in at 10.35%, and they've been consistently growing this dividend for the last 13 straight years. I know there's a lot of you guys out there who are already buying Starbucks like myself, but I also know there's a fair amount of you guys who are still sitting on the sidelines waiting for potentially lower share prices with this company. And for those of you out there, I'm curious to know, what price are you hoping for with Starbucks? At what point would you start buying again? Let me know in the comments. Anyway, moving on, guys, we are now at the third stock of the day. This one's kind of a wild card. We're talking about California Water Service Group, ticker symbol CWT, which I don't think I've ever talked about before here on the channel. This is a water utility company whose reach extends far beyond just California despite their name. They also service customers in in Washington, New Mexico, Hawaii, and Texas. Now, as you know, water is pretty fundamental for life, and so its demand stays relatively constant, which makes water utility companies like this one less susceptible to economic downturns and overall makes them pretty stable investments. With that said, though, CWT just so happens to be getting cheaper and cheaper by the day. Just in the last 30 days, they're down close to 10%, a very, very big drop in a short amount of time, but this is pretty on par with the rest of the utilities sector. Many of these companies have seen declines in the last month. And if we zoom out looking at their performance over the last year, CWT has seen a drop of about 22%, so once again, a very big drop for this company. But with that, the dividend stats are looking pretty good. The forward yield is coming in pretty moderate at 2.2%, which is about 30% above the company's 5-year average yield. And for the most part, the rest of the dividend stats are looking pretty good as well, with the exception of this payout ratio here, though. You see that's 143%, which is pretty insane, but I do believe this high payout ratio is a bit of an anomaly. If we look at the historical payout ratio over the last decade, it's a lot more manageable. And the payout ratio for this upcoming year is also looking a lot better. It's sitting only at 53%, but still, this is something I'd keep an eye on if you're at all considering investing in this company. Otherwise, though, I'd say the rest of the dividend stats are looking pretty good. The 5-year growth rate's coming in just below 7%, and a CWT is a dividend king with 56 straight years of dividend growth. So as you can see, they just have an incredible track record with the dividend, and I think all three of these companies would be pretty solid contenders if you're looking to make some additions to your portfolio. But having said that, there are still quite a few other stocks out there that I think you need to keep your eye on. The first of which is Chevron, guys. Just in the last month, Chevron is down another 6%, and this company's share price can't catch a break. If we zoom out looking at the performance over the last year, they are down 20.4%. Definitely keep an eye on Chevron. And with that, you got to keep your eye on ExxonMobil as well. Just in the last month, they're down 5.5%, but looking at the performance over the last year, Exxon is down 13%. Not as big of a drop as Chevron, but still, pretty big drop nonetheless. Also, guys, keep your eye on Altria Group. They're pretty flat over the last month, only down 0.3%, but looking at their performance over the last year, they're down about 9%. And then along with that, guys, keep your eye on BTI, British American Tobacco, who's actually up in the last month. They're up 1.25%, but they've seen a much bigger drop than Altria Group has in the last year. They are down 23%. Anyway, moving on, guys, another water utility company you should keep an eye on is AWR, American States Water Company. In the last month, they're down close to 6%, and looking at their performance over the last year, they are down a whopping 16.25%. Moving on, I think EOG Resources could also be one to watch, guys. They've seen a really big drop in the last month. They're down 9.5%. And looking at the performance over the last year, they're down 15.7%. So another big drop there. Anyway, guys, moving on, UGI Corporation is another one that I still think you need to keep an eye on. It's down almost 7% just in the last month, and it's seen a really big drop in the last year. It's down about 43%. This company's share price just cannot catch a break. Next up, keep an eye on the Charles Schwab Corporation, SCHW, who's seen another pretty big drop in the last month. They're down 7.7%, and in the last year, they're down 16.6%. Anyway, moving on, APD, Air Products and Chemicals, is another one that I think you need to watch. They're down 4.3% in the last month, and in the last year, they are down 13%. Moving on, guys, also keep your eye on Bristol Myers Squibb, BMY. This company's seen a really big drop all across the board. They're down 6.3% in the last month, and in the last year, they are down a whopping 32%. And then staying in the healthcare sector for another moment here, also keep an eye on Humana. They're down 9.5% in the last month, a very big drop for these guys, and over the last year, they are down almost 17%. Moving on, guys, over in the consumer staples sector, Hormel Foods cannot catch a break either, guys. In the last month, they're down 4.75%, and in the last year, they are down 32% exactly. Wow. And then along with that, guys, General Mills might be one to watch. In the last month, they're down about 2.5%, and looking at the performance in the last year, they are down a whopping 18.4%. Now, those are all of the stocks that I think are good ones to watch right now, but in this next video right over here, I'm telling you about 3 stocks that are the exact opposite. These stocks are trouble, and you would definitely regret buying them. So click right over here to find out which ones they are, and I'll see you in the next one.